Welcome into Clear Picture Financial. Your host is Jason Noble. And again, Prime Capital Investment Advisors, where you can find him right here in Charleston, the power behind this program. Check him out online. Great resource website, clearpicturefinancial.com. Again, clearpicturefinancial.com. Jason's a fiduciary advisor, holds his FINRA Series 66 securities registration, certified financial planner, retirement income certified professional, and folks, 18 plus years in the financial arena, helping his clients get ready for their retirement. I'm Morgan Patrick, consumer advocate. Each and every week, it's always about retirement. We also give you an opportunity to get on the calendar with Jason and his team at Prime Capital Investment Advisors. And these appointments are no cost, no obligation, simply no pressure. Listen up and grab one of those appointments. And if you haven't started planning, or if you're in the middle of something, need that second opinion, these are ideal for you. All right, so Jason, let's talk about this. High interest rates, volatile markets, recession talk. I mean, it could be, a detriment to your retirement. So we're going to talk about it today. High interest rates, volatile markets, and then the recession. And just in your own words, what does that mean? I mean, a lot of retirement planners, or retirees or pre-retirees, they're very concerned just about the climate we're currently in.
There are, and there's always there's plenty of financial approaches and strategies, tips, and even rules of thumb that folks, I think, could turn to when assembling their retirement plan. But unfortunately, with an economy that's plagued by market volatility, high interest rates, the talk of recession, the retirement planning rule book has changed. And so, in effect, to shed light on how these changes may impact your bottom line of retirement, we're going to cover a few of these classic retirement planning rules and the practical application of each of these unpredictable to in an unpredictable economy.
So I was going to just jump in. Can we play some classic rock or something, since we're going to do the classics? So, no. And again, we could probably go all day on the classic rock, but here is a classic. The 4% rule, we hear it everywhere.
Yeah, and it became a standard for folks really entering retirement in the mid-'90s, and it became more popular in the early 2000s. And it's just saying, what is the guaranteed income for the remainder of their retirement using the 4% rule? But, there's more to it than that.
And again, folks, I mean, how is the rule fared? I mean, obviously, there are going to be adjustments to it, but there's a reason why it's been there for so long.
So in the mid-'90s, what occurred is this particular person, I forget his name off the top of my head right now, but he did a rolling 30-year period of time all the way up into the mid-'90s, and looked at all the different environments of, if you had 50% stock, 50% bonds, how much could you take out as a safe withdrawal amount? And there was some 30-year periods of time you could withdraw up to 9% of your portfolio on a consistent basis. Other years, it was as low as 4%. So that's where the 4% rule came in. And then in the early 2000s, what they did is they started to add mid caps and small caps as well into this, and then the number went up to 4.5%. Here's the issue with it, though, Morgan, is let's say you retire with $1 million,
okay,
and then you take it $40,000 a year. What the rule doesn't account for is taxes, the tax drag on it. What the rule doesn't account for is changes like inflationary risk, like. $40,000 today is not $40,000 in 20 years from now. With a 3% inflation rate, that would have the same purchasing power of $20,000.
Right.
Then net after taxes? Oh, and if you're claiming Social Security as well, yeah, you maybe not have to withdraw as much, but then that's going to, if let's say you withdraw the same amount, well, then now you're going to have more tax drag because Social Security would be subject to income tax as well. So it's used as a rule of thumb, and I would say, I would use it at the back of a napkin math if someone was really pressuring me when I'm out socially. They go, how much do I really need, right? But when they come into the office, we don't look at the 4% rule as we're going into a complete comprehensive financial and retirement income plan. That's not how we do it.
Yeah, I was just going to say, I mean, we talk about it often here on the program, having a retirement plan, it's got to be individualized, or if you're retiring as a couple, to that couple, and everybody's going to be different. So your puzzle pieces are going to really determine, what you're going to need as you move to and through retirement. So make sure you take the opportunity to start planning, or if you're in the middle of something and you feel like you're a little stagnant, maybe that communication's not there, get a second opinion. And then the neat thing about this show is we give you that opportunity. We have spots on the calendar with Jason and his team, and they're no cost, they're no obligation, and simply no pressure. All you have to do is call 843-743-2926. That'll get you one of the appointments. Or you can text NOBLE, N-O-B-L-E, to 600-700. That will secure one of the spots. Again, limited number for our radio listeners, so jump on it right now. So again, going back to some tried and trues, we've talked about the 4% rule. What about the rule of 72?
Well, let me break this down. This is really a simplified formula to help measure how compounding interest can impact your investments over time. Like, for example, let's say your account earned 4%. Well, divide that by 72, right? And what you're left with is 18, which serves as a rough estimate of how many years it will take you for you to double your money. And interesting tidbit, this came from Benjamin Franklin. So it's been around for a while.
So let me ask you, since it came from Ben Franklin, and we all know the age of Ben Franklin or what he would be, is it still valid? Can we still use this?
Well, math is math. And so, yes, but not when it comes to planning out. And the reason why is because you have sequence of returns, right? So over a 10-year period of time, you could average a 7% rate of return, but what happened in the first year to the second year to the third year and all the way through, that is where the rule of 72 starts to break down, because it's not taken into the account the volatility within that, right? So you could use it for a fixed rate of return over a period of time, right,
okay,
to see how long it will take you to double. But yeah, if you're looking at doubling your money every, let's say, 8 years, you could see what kind of rate of return you're going to have to go with as a guideline, but you cannot be using that as your financial plan, because life doesn't work that way. It's not the reality.
I tell you, and really, you have to take things with a grain of salt. And as you mentioned it doesn't occur in a vacuum. Things do change, and you need to be able to roll with it, right? You need to be able to change with it. You need to be able to, work with a fiduciary that has your best interest right up front and put this plan together. Be ready for your retirement well before your actual retirement date. And then you just enjoy your retirement. That's what it's all about. That's what planning will do for you. You need to get in there and get started if you haven't, or if you feel like you're kind of floundering a little bit, it's just not, the feeling's just not there as far as whomever you're working with, get a second opinion. We're going to offer those up here in just a little bit. So we've talked about the 4% rule. We talked about the rule of 72. What about the magic number? The magic number we hear, 65.
Wow, I gotta say, this is one that's certainly going to surprise some folks out there, because, it surprised me. What I mean by that is I was meeting with this wonderful couple, and I asked them, when do you plan to retire? They said 65. I said, oh, why is that? They're like, well, that's when I could get Social Security. Well, no, that's when their parents could get Social Security. They changed the rules, right?
Right.
And I think a lot of that is coming down from earlier generation, right? And then they're talking to their kids like, oh, I started claiming Social Security at 65. I also think it was also Medicare. Medicare starts at 65. And so people believe that you have to wait till 65 to then retire. And I think it's not really based in anything that's factual. Because when I finished that conversation with the couple, I said, well, what if you could retire at 63? Would you? They're like, well, what would I do for healthcare? I was like, well, you could go on Medishare, you could go on the Affordable Care Act. There's other options. You could even look at Cobra for 18 months, right? So, but I opened up a whole new door for them by just with having the conversation. So yeah, they came in with the magic number of 65, but I think it's more to than that. And if you're listening, you're thinking oh, I gotta wait till I'm 65. I'm gonna ask you right now to think about why. Why 65? Where did that number come from?
Well, and how is it all going to fit into your plan? I mean, retiring at 65. When are you going to take Social Security? How is that all going to fit into what you really want out of retirement? And if you're flying blind, if you're doing this by yourself, if you're listening to maybe one of your neighbors or one of your relatives and how they did it, I mean, there could be some nice potholes in your road to retirement. So make sure you have a plan and you are absolutely positively ready to go. So here's what we're going to do. There are a lot of people out there that probably have questions about their own situation. We've got spots on the calendar. We're going to open up 10. There are 10 open right now, and they're going to remain open until they're filled. Jason, real quickly, just walk us through what's going to happen at these 10 appointments.
If you're listening, I would say it's time to act now, especially with all of the uncertainty in the markets, the economy, and the world right now. It's just so important to be proactive and not reactive. Not taking these rules of thumbs that we talked about and applying it to yourself and determining okay, this is going to work. Well, how? How do you know that? This is where we want to get to know you. And when you reach out, you speak to one of our specialists. This is where they schedule your custom core values meeting with me. I want to get to know your story, the story of your money, where your goals are and any concerns that you have right now. After we meet and I have that information, then we start building out your clear picture analysis. We look at a fee report with risk assessment. We also look at performing a tax analysis to reveal how you could possibly reduce your taxes and increase your cash flow. We also develop a customized income plan, utilize proven strategies that could strengthen your retirement income and take that worry of living in retirement. For the next 10 callers, that's a comprehensive financial review that we're going to provide complimentary with no obligation.